it's essentially important to understand, especially for those guys who have debt mutual funds, which I'm assuming many of you do have, since a well-balanced portfolio is something that does have a little bit of equity funds and a little bit of debt funds as well, pardon me. So what exactly do the RBI announcements mean for debt mutual funds? Because there was a lot of announcements made which would essentially enable liquidity, the cash reserve ratio requirement being lifted for certain kind of loans as well is something that would enable liquidity. And of course, it may sound a bit jargony for a lot of our viewers, but fixed income and debt funds are essentially filled with a lot of jargons. Nevertheless, let's try and de-jargonize that for you. I have with me Devang Shah, the Deputy Head Fixed Income of Axis Mutual Fund, joining in right now on the show. Devang, thank you so much for joining us on The Money Show. Whenever the RBI does make some announcements during their policy, it does have implications for bond yields, which in turn affect debt mutual funds, from the short tenure funds to the long-term funds. Now, I want to start off by talking about this new tool the RBI has introduced called the long-term repo. What does it mean for banks and also subsequently for perhaps even the bank's customers? If you could explain that first to us in simple terms, and then we'll move on to the impact on debt mutual funds.
So see, RBI has announced this long-term reverse operations, and it's a very, very innovative tool. In simplified format, what RBI is telling banks is that you can come and borrow against GSEC from me for 1 year and 3 years at 5.15, which is the repo rate today, and lend this money into the system. So this is very, very positive for banking segment. It adds to significant banking liquidity. Secondly, it also helps for credit transmission. And thirdly, I think it is a very, very effective tool for getting the lending rates lower. So in summary, it is beneficial for banks on a total basis to borrow at lower rates, and for the end borrowers also, the rates would come down. That is what we believe so.
Okay. When the RBI made these announcements, we saw the 1 year and the 3 year yield spike significantly. Again, just to understand it, for our debt funds, what does a spike in these short term, you could call 1 year and 3 year yields short term, what does that mean for the different categories of debt funds that are out there?
So I think last month, post the announcement of OMO twist, where RBI was selling the short bonds and buying long bonds, we had seen some kind of spike in the short-term bond yields. Post this announcement of LTROs in the monetary policy and various other measures which RBI had taken, including a very, very dovish, I would say, forward guidance, they communicating that there is room for rate cuts available. Incrementally, there are various steps which RBI is also taking, like reduction of CRR for various retail assets. Similarly, going away or deferring the NPA recognition for commercial real estate and MSME. So I think on an overall perspective, RBI was very dovish. With this long-term reverse operations being announced up to a tune of 1 lakh crores, I think we believe that the short bond space will rally from current levels. Already since policy, we have seen a 20-25 basis of rally in 1 to 3 year bonds. We believe so we can see another 10 to 15 basis rally from here on. Very, very positive for the short bond space.
Okay, excellent. And yeah, you mentioned Operation Twist. Even that was essentially to reduce yields on corporate bonds. So I want to talk about that segment of debt funds because a lot of viewers, may be interested in corporate bond funds as well. How do you view corporate bond funds in terms of return potential?
So our view is that if I look at the macro analysis today, we believe that growth continues to hover sideways. Yes, all this directed push of credit, all the measures taken by government will start seeing some impact on the growth. But I think growth recovery is somewhere down the line in H2 FY21. Similarly, on inflation perspective, yes, near-term inflation looks on the higher side, but on a medium-term perspective, we believe that both core and headline inflation will continue to hover between 4.5% to 5%. In this backdrop of macro analysis, where growth continues to remain weak or at the cusp of recovery and inflation well under control, we believe that RBI would be on a pause mode for most part of this year. With announcements like LTRO, possibility of rate cut, forward very, very bullish guidance, we believe that the short bond space can rally more. Even the long bonds, the entire fixed income space can rally from current levels. So at this point of time, yes, our understanding is that the entire fixed income curve looks very, very positive. Corporate bond spreads are very attractive. If you look at 3-year corporate bonds, 10-year AAA corporate bonds, as well as 2-year, 3-year AA bonds, I think the spreads over overnight rates are very attractive. If a bank is getting up to 1 lakh crores of money at repo rate, and if 2-year, 3-year corporate bonds are traded at 620, 30 levels, 10-year corporate bonds are traded around 7.25, and 2-year, 3-year corporate bonds are traded at around, AA corporate bonds are traded around 8% plus, I think today it makes a lot of sense for investors to capture corporate bonds into the short to medium term space, including credit.
So, Devang, just to summarize it for our viewers and to make it simple for them, now, given whatever the scenario looks like you mentioned, growth is weak, inflation is, within range, so RBI will not cut interest rates. For an investor looking to invest in the debt mutual funds, like I mentioned, there's low duration, long duration, gilt fund, corporate fund. What sort of adjustments would you recommend based on the current environment?
So our view is very bullish at this point of time. I think the budget, government just did the 0.5 breach of fiscal deficit, which was within the FRBM Act. The monetary policy was a big complement to the budget. The entire push was on credit, improving banking liquidity, flow of credit to the economy, as well as ensure that transmission of rates happen from here on. So we are constructive onto an entire fixed income segment. I think the short bond space and credit funds makes a lot of sense for us at this point of time. So in our portfolios, we have added, we already had a very high core portfolio onto 2-year, 3-year corporate bonds. We have added more 2-year, 3-year corporate bonds, both on AAA and AA. And we believe that there are tactical opportunities also onto the long bond space.
Okay, so again, RBI has essentially kept rates as is, stance is accommodative. What sort of duration mix of debt funds should individuals have of their debt, of all of the debt funds? How much should be in long term? How much should be in short duration? Give it to our viewers.
So I continue to advise clients to stay invested into short to medium term space, because we believe that for most part of this year, RBI would continue to be on a status quo mode or a pause mode. Yes, we can see one rate cut, but post that we don't believe that there will be too many rate cuts, as well as we don't anticipate any rate hikes too in this year. So in a pause kind of a scenario, we continue to advise clients to stay invested into short to medium term duration funds, because we believe that we are at the cusp of recovery when it comes to the growth cycle, as well as the credit push which has been given by both government and RBI. I think the credit cycle is on the uptick. Spreads are very attractive. Investors should also allocate to short duration credit funds. So these are our advice at this point of time to investors.
Okay, short duration credit funds, that's where you could put a nice chunk of your money in to look for some return potential, according to Devang. Thank you so much then, Devang, for joining in and helping our viewers understand how they can make money post the RBI announcements. Okay, well, folks, on that note, we will take a very short break. But when we return in our Spend with TMS segment, we're going to help you buy luxury without spending off half of your salary. How, you may ask? Well, stay tuned to The Money Show to find out.